Hey guys, Max here, and this is your daily market update for yesterday, the 28th of January. It's going to be a little bit of a short one today, but we're going to take a look at the rally we saw in the markets yesterday, along with a couple other things, so let's just get right into it. Now, what actually happened in the markets? Well, we had some strong earnings come out from companies like Apple and Visa recently, and that gave the market some confidence, and we ended up seeing a pretty strong rally for the day, with the S&P 500 rising over 2%, the Nasdaq rising over 3%, the Russell 2000 was up almost 2% as well, and the Dow Jones was up by 1.6%. Basically, there was just a bunch of reassuring news coming out regarding some of these big companies, and that gave some confidence to investors that the economy is actually in good shape, and that should help asset prices. Of course, there is still a lot of fear going around, and volatility is still very high. The Nasdaq rising by 3% in a day should not be a normal thing to see at all, but it has been over this last month. Now, over this last week, it was actually a pretty crazy week as well. Of course, we had the hawkish tone from the Fed, and prior to that, we had investors betting that the tone of Powell would be a little bit dovish. But then we have the fact that the Fed isn't actually doing anything about inflation yet. They're still talking about doing things in the future. Markets are now pricing in far higher interest rate rises and far more of them than they were before. The consensus about a month ago was that we'd see 3 rate hikes in 2022 and that we'd probably end up with interest rates sitting at about 0.75 or 0.9%. But now we're expecting 4 or maybe even 5 or maybe even more rate hikes, as inflation does not seem to be subsiding as the Fed had hoped it would. Now, there is lots of talk about what kind of investing environment will exist when these rates actually rise, with people basically arguing over whether or not stocks can still actually go up as interest rates go up as well. January as a whole has been characterized by this, and it's now been the worst January in history for US equities, even with this strong day to finish it off. Now, stocks are still down by and large, and sentiment is actually still quite poor. Really confident bulls like Meet Kevin, who were adamant that companies like Peloton were just going to keep getting bigger and bigger, keep growing and justify their crazy valuations, well, those people are changing their minds, with Kevin himself selling out almost entirely of the market a few days ago now. Now, I've gone on record saying that I expected to see this dip in a couple of months' time and that I expected markets to keep squeezing out profits for the time being, but I'm more than happy for it to come earlier, to be honest. My major concern with all of this is that the Fed might go back on their word and refuse to fight inflation as asset prices fall, and if that happens, then inflation will literally become every person's biggest problem. Other than that though, in the markets, currencies didn't see any major change, with the dollar holding on to its recent gains. US 10-year treasuries have seen a slight fall in their yield, now sitting at about 1.78%, but that's still comparatively high compared to recent months. Oil, of course, is still very expensive, with Brent crude sitting at around about $90 and WTI crude around about $87, which is not good news for inflation either. Gold is still sitting at just below $1,800 an ounce after falling on the idea that the Fed will fight off inflation, which I'm sure you all know at this point I think is pretty unfounded. Now, crypto did have a strong day, following in the footsteps of tech stocks once again being very closely correlated. We saw gains of roughly 5% across the board for altcoins and just a tad bit less for Bitcoin and Ethereum, with them now sitting at $37,000 and $2,500 respectively. Of course, the situation in Ukraine has been developing and tensions have been rising, and we're going to spend some time tomorrow looking over what the new developments actually are and the direction that whole crisis is moving in. But that is, of course, proving to be very worrying for markets as well. It's very quickly become clear that despite the fact that Russia is not a very big economy, and it's certainly nowhere near as influential or powerful as the USSR was during the Cold War, it does have certain aspects of leverage which it will use to its advantage, the most important one being the supply of oil and gas to Europe and Europe's lack of energy security. Now, Apple, of course, had a good day yesterday. They had that strong earnings report that we spoke about yesterday, and their share price rose by 5%, and it's now up about 8% on where it was a week ago. Apple also announced that they're going to be fighting Square or Block with a brand new branch of their company. They're planning a new service that will allow small businesses to accept payments directly onto their iPhones without any extra hardware. Apparently, this has actually been in the works for about 2 years now, and it's obviously going to be quite similar to Apple Pay. Square, or Block as it's now called, have basically made this their entire business model, and they're going to struggle to compete with Apple, in my opinion, as they have the home ground advantage, and the people who are using this software are also probably going to be using Apple's hardware like iPhones as well. Of course, Square is run by Jack Dorsey, who is a little bit insane, to be honest. He used to run Twitter as well, but left to run Square full time and has now changed Square into Block with the intention to run it off of blockchain technology and basically turn the company into a crypto payment service. The problem is there isn't really a comparative advantage behind this shift. And while there may be an advantage there in the future by using crypto or blockchain technology for these sort of payments, it isn't there yet. And now they're going to be competing against the best run business in the world, which is holding $200 billion of cash that's just sitting around waiting to be invested somewhere. Block has behaved just like every other medium-sized Nasdaq-listed tech company recently, with its share price falling by over 60% from its all-time highs. Now, one thing that is worth noting about this move from Apple is that Amazon, Apple, these kinds of companies that just dominate every market they move into, they're getting very close to being considered monopolies, and they're already seeing some problems with monopolistic practices. The EU is tackling them with legal action and the like, and there's a lot of rhetoric going around over the last couple of years about curbing the power and influence of these firms. We may be looking at a second great American anti-monopoly tirade where these tech giants all get split up. Add onto that the fact that loads of these smaller Nasdaq tech companies are bleeding money, investors don't have an appetite to buy and hold them, and the macro environment is looking poor for the future, so maybe Apple and some of these other actually successful, well-run firms start buying up the failures and integrating them into their systems. Now, Goldman Sachs came out and said that the best move for most of their clients is just to stay invested in the markets right now and to ignore all of this volatility, to keep buying into stocks at a steady rate, as confidence that in the long run, this kind of strategy will win out is still strong. Now, I thought I'd just say that for most people, this is actually the right advice, and in the long run, it's easy, it doesn't involve any stress, it has hardly any risk, and while it may take a while for it to play out, it will ensure you make really good returns. That being said though, Goldman Sachs' clients are not normal investors. They're not small-time investors who are just contributing to their pensions. And all over December and for January as well now, investment banks across the US, including Goldman, have been putting out statements claiming that the downside for US equities is overstated, that we're nowhere near the end of the bull market, so everyone should keep their cash invested. Of course, Goldman and all these other investment banks that are making these statements, they want their clients' money so they can get paid, so we really shouldn't be too surprised at all to be hearing this. Now, Netflix, of course, saw a bit of a pump of its share price yesterday, but at the end of the day, it actually lost those gains that it did make. Of course, the company has struggled over the last 6 months with its share price consistently declining, and then on their most recent quarterly reports, the stock tanked as growth slowed right down. Now, some people think this is a pretty good buying opportunity, like Netflix's co-CEO who just bought another $20 million of shares, which is a strong indicator that he thinks the company is going to do well and that maybe the share price will increase as well. Of course, we also had news that Bill Ackman bought 3.1 million shares through his firm, so he clearly thinks it's a good deal as well. Whether or not the company will actually be able to perform well in the changing macro environment is a tough thing to predict, and despite the fact these two high-profile names are buying the stock, its price and sentiment around the stock isn't actually rising. Now that is it for the day. I'm sorry it was a short one, but we'll have plenty to talk about tomorrow and Monday. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world-famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support, thanks for watching, stay stoic, until next time.